All right, Danielle, you there?
Yeah, I'm here. Hi,
Sounds
Trevor.
good. Hello, and so we're going to talk about some opportunity zones. It's a hot topic, as you know. Can you see my screen?
Yes.
Okay, great. I am going to put over a couple tabs of information on opportunity zones, and I think after this call, we'll do a little blog article on what opportunity zones are, as well as have these links in the blog article, so people can kind of take a look at these and dive into them a little bit afterwards. Does that make sense?
Okay. Yep.
Okay, cool. So I think the four items that we want to hit are, what are opportunity zones? Who can kind of take advantage of opportunity zones? Why should they be taken advantage of? And then how and what is the best form of getting involved with them? So that being said, what an opportunity zone is essentially the IRS, and we can see a map right here of what actually this is obviously all the U.S. Right here is the Department of Treasury's website that has some of these links. And it identifies in blue all the opportunity zones that exist in the U.S. And so what these are, and we can kind of zoom into the Atlanta area in particular, because that's kind of familiar with where we are. But the Department of Treasury has identified these areas as economically depressed, and they want to revitalize these areas by giving preferential tax treatment to people, and this we quickly get into the who, to people who have essentially exited their companies and have some excess cash that they can now put to work. It's if you remember what a 1031 exchange is, been around for a long time. It's very similar to a 1031 exchange in that you may sell a rental house, a residential rental house, and if you identify like-kind property and invest those funds, the proceeds from that sale, in another residential real estate property, then you don't have to immediately pay tax on the sale of that residential rental property. And so it can grow tax deferred. You can buy more of a house essentially in that scenario than you would with after tax money. And so this whole opportunity zone piece of the tax reform is a very similar principle, but it's for operating companies in particular. Okay, so the who really, I think, that we're going to see as this kind of develops is really going to be the business owner that is having an exit. And so I'll go through an example as well. Let's say, you sell a tech company for $20 million, and then you want to maybe put $15 million in an opportunity zone. Why would you do that? What is the benefit of it? Essentially, okay, I've sold this thing for $20 million. I'm going to take $5 million out in cash, do whatever I like. And then the other $15 million, I can't really do anything with. I may, typically in the past, you may put it into a money market, some cash, diversify into some mutual funds, maybe do some angel investments or private equity. You may even start another business, whether it's in real estate or retail or tech. So these are like the typical things that people would do. But now I think we have a little bit more of a lucrative investment that we can do the whole 1031 exchange investment with and invest more into a particular zone. So the tax benefit here is, yes, after sale, we can defer a portion of the proceeds that are reinvested into specifically one of these zones. And then at year 5, I'm just going to scroll in here. It's funny, like Southwest Atlanta, you can see a decent amount. There's a zone right over here by the Georgia Dome, by Turner Field. You scroll out a little bit. There's some, let's see here, we have Stone Mountain area, I think a little bit over in Smyrna and Marietta. So they're quite common and they're drivable. And so the big tax benefit outside of the deferral and the Department of Treasury and the IRS is they're encouraging long-term growth in these areas. And so at year 5 of you having an investment in this area, of that original, say, $15 million that you invested in the qualified opportunity zone, they're going to exclude 10% of the allocated gain from that original sale. Okay, so it's 10% then gets excluded at year 5. At year 7, another 5% gets excluded. And then right now in the year 2026, they'll have a taxable event essentially on the non-excluded gain. And I know we're getting kind of technical, but this is kind of the high level of where it's at. And then if you still have the investment after 10 years, the appreciation of that investment is actually excluded entirely from gain. So for example, if we invested $15 million here in 2018, hold it for 10 years and say now it's worth 25 million, then that $10 million of growth is potentially excluded from gain. And so right now we're in the area of tax analysis that we have looked at the code, we've read as much analysis as there is, but indeed we are waiting on the IRS and the Department of Treasury to kind of give more information of how they're going to delegate the administration of this and some of the treatments in particular of the types of investments that they're going to have in the opportunity zones. But that's kind of the high level of where it's at. As far as how to invest in these funds, that is what is, I think, still being developed. If you read the websites and the code in particular, you have to invest in a fund in these zones. And so I think these funds are being developed right now and will become available to people more readily. That being said, I think it'll probably be another blog article or video call once these come to light, and then we can analyze those a little bit more. But that is where it's at for now. Hopefully that answers your question, Danielle. Let me go back over here. The couple websites that are brought up, the cdfifund.gov is one of them. And then right here, it has the link to these maps where you can dive a little bit deeper, as we were saying. And then there's also some other revenue procedures that go straight to the code that you can read for yourself. That being said, we'll go ahead and end this call and pick up next time when we have a little bit more information from the IRS and Treasury. Sound good?
Thanks so much, Trevor.
All right. Thanks, Danielle. Bye.
Bye-bye.